New Year is always a good time to take a fresh look at your finances, and from Pacific Financial Planners, we want to welcome Jerry Slusowicz to the program.
Well, thank you for having me. Appreciate that.
Happy New Year. And so, like I said, this is a good time to know where you stand financially, right? Take a look at what happened last year, where are we looking for this year, right?
Yeah, absolutely. I mean, one of the most important things is to really know where you are, know where you stand. And that's so important when it comes to finance and investing. And I'll be honest with you, 35 years of doing this, a lot of people don't, but it's always a good idea. People make New Year's resolution, what are the 5 F's, faith, family, finance, fun, fitness. There we go. So finance, that's me.
Right. And so, so a lot of people have that 401k and they've been putting it in there, and they don't look at it. Like you say, they don't really check it. I think it's good. I think I have a 401k, and I think that maybe they're kind of scared, look at the finance. They don't understand it, so they just kind of hope it's going well, and that's probably not the best strategy, right?
Yeah. And a lot of people that are younger and still working, they're contributing, and they go, oh, well, it's up. Well, that's because you put a bunch of money into it. But yeah, there's no doubt. It's not one of those things. Having health and wealth go together, and you do need money. And when you do retire and stop taking the paycheck, it's even more important to take an inventory of where you are, where you stand financially. I use a lot of analogies, and so, like, for example, let's say you and I want to take a trip to New York. Well, how much money do we have? Are we going to fly there? Are we driving there? What's the best way to get there? Now, let's say we're going to drive there. Okay, it's January 3rd. Are we going to go the northern route, go through snow and ice, or are we going to go the southern route? Or if it's the summertime, do you really want to go through the desert heat? So it's the same thing with the markets. What's going on with the climate and the market? So you've got to know where you are and know where you're going. And so, that's the old, what was it? Any way you want to get there, it would work if you don't know where you are. I can't remember. There's
a saying somewhere out there like that.
There's a saying somewhere, yeah.
Past is not a predictor for the future, but we had a crazy last year with interest rates, and there were definitely some winners and losers. And so as we look down the road this year, the Fed says, hey, we're going to lower interest rates. So what should people be doing differently, knowing that at least that is coming? Is there something that we can specifically do there?
Yeah, lock in the higher rates today. I mean, it's really important. We were given a gift last year. We had rates that went up 25%, which is a big increase in the course of the year. And then it dropped it by the end of the year. And some of these things still haven't come down in terms of interest rates. So if you can lock in for longer in terms of earnings right now, these are rates we haven't seen since 17, 18, 20 years ago. So that's a pretty good idea right now because they're giving you good opportunities.
So like treasury bills and things like that, is that what we're talking about here?
Absolutely.
In terms of getting those high performing, kind of high yield rates of return?
Correct, because if inflation starts to lower, the rate of cost starts to not go up as fast, that's what's going to cause these interest rates to go down. If we have, let's say, a 3% inflation rate this year, and we're still at 5% on interest rates, that's a 2% real rate of return over the cost of money. So you want to kind of lock that in and create a portfolio of staggered maturities. So some of it's short term, in case we're wrong and rates go up, and some of it's longer term to hold these higher rates, because that's what we think is going to happen exactly.
What are the things that are maybe some good bets or bad bets for the coming year? What are you looking at and saying, okay, this is a way we're going to go? I mean, I know you don't like to be a prognosticator, but
well, generally, because it's an election year, it's a very high probability that that's a good year. And a lot of people say, oh my gosh,
like for the stock market and just in general?
Yeah, for the economy and stock market.
And with interest rates coming down, that's going to let companies borrow money easier, right? So they're not going to be locked in those high rates. It was free money for such a long time for so many companies. That's why they were borrowing so much.
That was years and years ago. For years and years, they were able to borrow money with zero cost. Now that cost of money's gone way up. So as rates come down, it's going to help the housing market, which will help a lot of business, a lot of economy. It'll help businesses who borrow tremendously. So it should help the stock and the bond market tremendously. And a lot of people are afraid because of the divisiveness and the politics. We've got money in markets and politics. They're not the same. They're separate. But most times, incumbents get reelected, okay? Most times, okay? And that's, I'm talking about local elections, state elections, and federal as well. So they're on their best behavior to try to make things look good. Since 1900, 32 election cycles, 31 of them have been positive. That's 130 years of, 120 years of data. So that's a lot.
It's a pretty good track record to say this is a
record.
pretty good predictor for where we're headed.
So by the end of the year, here's my big prediction. You asked me.
Okay, here we go.
I think by December 31st, we'll be higher than we are today.
Okay. Okay.
I think the beginning of the year might be a little herky-jerky because we did have a little run-up at the end of last year.
Right, and all the indexes almost came back to their pre-pandemic kind of levels, right?
Yeah, but you got to talk about, gosh, that's a long time to break even. There's a couple, like the Dow hit a new all-time high but right before the end of last year. The S&P 500, which is your broader 500 index, or the NASDAQ, did not. But, to say, wow, let's celebrate, we're almost even from years ago, that's not that great. So you've really got to, again, it goes back to where are you, how's your money allocated, are you taking too much or too little risk? It comes down to the individual, and it's a good idea to kind of get that reviewed.
So what would you say to seniors these days? Because they'd have a shorter window, right? What's a better strategy for their investment planning these days?
Well, again, that's along the lines of what you're saying, is that long term, when people talk about long term in the market, they're talking 20, 25 years.
Right.
A lot of seniors don't have that 20, 25-year time horizon, especially if you're drawing money off. Not everybody needs to draw money off, but a lot of people, that's what they saved in their 401k to do, is to pay themselves from there versus the paycheck. So you want to be in a more conservative strategy. And a lot of people here in the village say they're conservative, but they love the stock market. They just love it. They're infatuated with it. And I see people with 80, 90% of their money, well, I'm in mutual funds. Well, those mutual funds are in the stock market.
Stock market.
Yeah, but they don't realize it. So there's a couple things you could do. One is if you use risk investments like stocks and mutual funds and that sort of thing, have an exit strategy. I call it the CPR method. Control your costs, protect each position to reduce the risk. Look, you want it to go up, but if it's not working, have a decision of how much you're willing to lose.
Right.
People say, well, I don't want to lose money. Yeah, nobody wants to.
Yeah.
Or you can use no risk investments, banks, bonds, and insurance companies, things like CDs, treasury bills, corporate bonds of highly rated, your Intel, Johnson & Johnson, Bank of America of the world. Those things are safe. You hold them to maturity. You cannot lose as long as those issuers are intact. And then there's other investments through insurance companies that if the market, you could participate in the stock market. If it goes up, you make money, you participate in the upside, and if the market goes down, you cannot lose.
Okay.
Those are also good for seniors to really take a look at and see if that's good for them versus a lot of people, like I said, have way too much risk here in the village. And then there's other people on the other side who have all their money in the bank and they don't want to take any risk. And as long as they have the income flow that's going to last their lifetime, that's an okay strategy. But I see people who don't have enough money doing that strategy, and that's not good either.
Right. And there's a lifestyle that when someone sits down with you and says, hey, okay, I'm ready, I think I'm ready to retire, start taking that draw, there's an assessment, okay, well, what's your monthly spend? What do you want to do? How long? What's your,
time frame.
Over what kind of time horizon are we talking about pulling this money out of, right?
Right. And then the last bit to that people fail, and even financial advisors fail, they say, okay, good, you need $6,000 a month, you'll get $3,000 for Social Security, we'll take $3,000 off your portfolio. But they forget about inflation. And we saw that hit really hard over the last few years where seniors suddenly who thought they were okay, when costs are up 16, 17% over the last few years, and they're not going to go back down. Just the rate of cost isn't going up as much, okay?
Right.
They're like going, oh gosh, now maybe I don't have enough money. So you've got to calculate how much money you have today, how safe is that income to last over your lifetime,
right.
And then you've got to make some hypothetical guesses of what the cost, especially healthcare costs, how much is that going to go up?
Right, and that's always a factor that people in the early days of retirement don't always think about, that the healthcare costs in the last years of life can be really substantial.
Yeah, people think, there's 3 stages of retirement, right? Your go-go days, your slow-go days, and your no-go days, right? And I've been around this, community for 30 plus years to see that all the way through, my own parents as well. And your spending doesn't go down. You think, okay, I'm going to spend more at the beginning and take these big vacations, et cetera. No, you're spending it on healthcare at the end. So you've got to have a plan for all those costs.
Right.
And even if you have a financial advisor and you feel you're okay, it's always a good idea to get a second opinion and just have someone who's been around, knowledgeable, take a look at it and say, hey, look, I reach across the table and say, you won the game of life. I've done that to a lot of people here in the village and tell them, hey, look, your plan's great. And other people have said, here's some holes in your plan, and they could go back to their advisor and fix it, or they can go to somebody else and have them help fix it as well. So that second opinion is always a good idea here, especially at the start of the year.
Well, if you're looking for a second opinion or a first meet, we got Thursday, January 11th, 3 p.m. to 5 p.m., Clubhouse 7. You'll be out there kind of doing what we're talking about today, right?
The Financial Forum, it's a club here in the village. It's free, no RSVP. Show up. You can ask any questions. You can sit silently. We don't take attendance. It's great for people who are worried but don't know what to do.
Okay. Jerry, thank you so much, and Happy New Year.
Appreciate it. Thank you very much. Happy New Year to you.
Thank you. We'll be right back with the Theater Guild. Stay with us.